Trade between two nations isn't always balanced. In the United States, we typically run large trade deficits where we export less than we import. We buy more things from foreign nations than we sell to them. It's important to recognize that buying and selling foreign goods means we exchange dollars for foreign currencies so that we can exchange these other goods. And the supply and demand for dollars in foreign markets needs to be balanced. There needs to be the same amount of dollars flowing in than flowing out. So the supply of dollars has to match the demand for dollars. But if we're buying more goods than we're selling, then we have an oversupply of dollars on the world market. We want to take more of our currency that we earn in dollars and use that to buy foreign goods than people are using to buy our goods back from us. Now, this imbalance is corrected in the capital market, and we'll talk a little bit more about this in future slides. The net capital outflow is the amount of capital flowing out of a country. This is the difference between the domestic purchases of foreign assets and foreign purchases of domestic assets. In the United States, we run trade deficits, which means that there are net capital inflows. Essentially, the extra dollars flowing out that we use to buy foreign goods and services that don't flow back when foreigners want to buy our goods and services flow back to us in the form of investments in U.S. assets. So the excess dollars that are generated by our negative net exports come back when foreigners invest in our country, in the assets in our country. These investments take two forms. The first is foreign direct investment, and foreign direct investment is when foreign firms actually manage investments in other countries. That is, if McDonald's opens a store in France and manages it, then this is foreign direct investment. The other kind is foreign portfolio investment, when foreigners purchase financial assets, including stocks or bonds or currencies in foreign countries. And effectively what they're doing here is supplying loanable funds to the domestic market. They're making their funds available for investment in a different country. So when foreigners buy stocks of American countries, this is for foreign portfolio investment. What kinds of things influence international capital flows? The first is real interest rates on domestic and foreign assets. Investors would like to invest in countries where they can earn the highest return on their money. And if the real interest rates available for investment in a particular location are high, capital will flow to that country as investors seek opportunities for high returns. If investment opportunities in foreign countries are better in terms of the real returns, the real interest rates that they can achieve, if they're better in foreign countries than they are here, the money will flow out. The capital will flow out of the United States and into foreign countries. So places that represent good investment opportunities will tend to attract high capital inflows. In the United States, we've been a growing economy for many years, and that's part of the reason why we see such large capital inflows. And this is part of the reason why we're able to afford our trade deficit. The third item is the perceived risks of holding foreign assets. Foreign assets may have different levels of risk, and so if an asset is perceived to be riskier in one country than it is in another, even for the same expected return, this will discourage capital inflows. Investors will tend to prefer, other things equal, to invest in relatively safe opportunities rather than relatively risky opportunities. The U.S. dollar and treasury bonds are perceived as a very low-risk asset relative to lots of other investment opportunities around the world. And so one of the assets that's in very high demand oftentimes, especially through the global recession, was U.S. treasury bonds. These were perceived as a safe asset when the global economy was going through difficulties in the financial crisis. Finally, government policies matter as well. Governments have influence on the kinds and levels of capital flows that can occur between countries. Governments can restrict the flow of capital and restrict the flow of funds across nations. One thing to recognize is this: we talked about this issue between between supply and demand for currency to be used in foreign transactions. Note that net exports has to be equal to net capital outflows. That is, if we have a trade deficit, like we do in the United States in most years, The net exports is negative, which means we must be having net capital inflows. That means investment funds must be flowing into the United States. When a foreigner purchases a good from the United States, our exports increase, and therefore our net exports increase. The foreigner pays with currency or assets, and so the U.S. acquires some foreign assets, which causes the net capital outflow to rise. This is the exchange of currency. The intuition behind this is that if we want to buy more goods than we're selling in the rest of the world, we have to get the money to do so by selling investment assets to make up the difference.